Welcome. You're on the Fringe Show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. The Fringe helps you to navigate the rapidly changing world and increase the odds of your success. Here we discuss technology, startups, entrepreneurs, and mental models of successful people so that you too can take advantage of the opportunities in the new digital world. And today we're going to talk about one such opportunity, which is fractionalization of digital assets and physical assets as well, with a focus on art and collectibles. It's episode number 36. Have you ever wished you would have owned an iconic piece of art like Banksy or a valuable NFT such as a CryptoPunk? Well, NFTs like CryptoPunk and Banksy's paintings can be very expensive, and you could not possibly cannot spend millions of dollars. But with fractionalization, you can now own a piece of these very unique and valuable properties or digital assets, some of them. What I'm going to talk about today is what is fractional art or fractionalizing art. What does it really mean? There are two ways of fractionalization. One is a physical artwork itself and the digital piece or NFT. So we'll talk about that. I'll talk about the benefits of fractionalization, why fractionalize. Successful projects, I mentioned a couple of them. We'll talk a little bit about investment potential in digital art and fractionalized art, and some legal aspects. We can't really not talk about those as well. I want to, again, as a usual disclaimer, I want to say that whatever I'm presenting here should not constitute financial or investment advice, even though we do talk about financial assets and investments. It's not legal advice either. All I'm doing on the Fringe Show is really for informational and educational purposes only. And I wanted to start with one particular showing you one particular painting. It's by Banksy. Let me see if I can share it with you guys. Okay. I think I now can. That's a famous painting by Banksy. Banksy is a pseudonym for an artist. It's either him or she. We really don't know, but it's a very successful contemporary artist. It's his paintings, or his, I assume it's him, are characterized by a recognizable subject, very laconic language, graphics, visual directness, and all of that has helped cement Banksy's place as an artist with a penchant for social and political issues and focus on these issues and solving them through his art. Love is in the Air, what you see here, portrays a militant dressed figure, as you can see, leaning with a drawn back arm, as if it's going to throw something, and that something is probably, could be a Molotov cocktail, but instead it's a bunch of flowers, it's a bouquet, a floral bouquet. And the choice of color portrayed in the bouquet of flowers combine the colors of the Israeli and the Palestinian flags. And that's underscoring, again, Banksy penchant for social political issues and overcoming discord and disunity through art. Let me just come back and remove that from my screen. Right. So now let me start with a couple of quotes from, it's coming from Louis Gouzier, who is the ex-head of contemporary art at Christie's and co-founder of Particle. Particle owns now this Love in the Air. He says that I've always wanted to own art, even when I had absolutely no money. I wished I could have at least a tiny stake in the paintings that I liked. And Particles is such a new NFT company that aims to fractionalize ownership of traditional artwork and converting them into a set of NFTs called, well, not surprisingly, particles and allowing for potential thousands of people to share in the ownership of these paintings. It received $15 million in funding from a venture capital firm, and with this money, this wish of Louis Gouzier owning a piece of really valuable art is now a reality. Their first acquisition is Banksy's Love in the Air, and the particle team acquired it for nearly $13 million in an auction. The work has been segmented into 10,000 NFTs, each representing a unique section of the painting. An initial offer of the Love is in the Air began in January this year, and it allowed collectors a chance to purchase a particle of the work for only $1,500. It's not much, isn't it? And after this initial offering, the particles will enter the secondary market across all NFT platforms. An interesting question to ask, okay, that's the digital part of it, but what about the physical version? And the physical version of Love is in the Air will be handed over to Particle Foundation, the nonprofit arm of the company that will maintain, preserve, and tour the work so that collectors can see the pieces they can rightfully claim to own. Royalties received from the resale of particles will be partially used to fund this Particle Foundation, and the foundation itself will retain at least 1% of Love is in the Air to act as a protection and to ensure that no person can claim possession of the actual physical painting. Particle and the Particle Foundation have actually a very interesting ambition. They've stated their ambitions to create a kind of a meta museum which combines the stewardship of traditional institutions with the exclusivity of a private collection and the returns and risks related to the very volatile digital market of NFT trading. They're also saying that, or rather he's saying, that Particle Foundation is going to be a museum for people, but also by them. It will be great to see art like that because pure enjoyment of art is not complete until you feel you own it. So ownership is a great contributor to this feeling of the value of art. So what's the problem that art fractionalization is solving? And as I said, it cannot only be art, it can be collectibles or collections of collectibles. Although art collecting as an investment is a vision that has been carried out for centuries, it wasn't really until the last couple of decades that the financial sector has seriously approached the art world in order to diversify their investments with innovative methods. And NFTs and fractionalization is one such method. Fine art has long been an inaccessible and illiquid asset. It's been exchanged mainly among the ultra-wealthy and through auction houses. And while it's easy to buy a share of a company, for example, and we all can do that, a comparable mechanism hasn't existed for art until very recently. Art funds, like individual works rather, are also exclusively marketed to very wealthy individuals and maybe even close to new investors. So comes in tokenized art or fractionalized art. Tokenized art has become a new alternative investment vehicle for individual portfolios. More people, because of that, will be able to access art as an asset class, since they can buy a fraction of a very valuable artwork by purchasing a blockchain-secured token instead of having to purchase an entire artwork. Art is uncorrelated with public stocks, and that's very good news for investors. And according to the CEO of Masterworks, another company that I will mention shortly, it's as good as it gets, really. Now, let me talk a little bit about Masterworks. It's another very interesting project. It's not a very new project. They started in 2017, but it's very interesting because they describe themselves almost as an antithesis of the NFT phenomenon. They're not sure it will last, but they know that fine art will last. Plus, they're a unicorn. They've recently become a unicorn with their recent round of investments. So what they're trying to do is to invest in paintings by the best-selling artists of all time. They're launching platforms to sell fractional ownership of artworks, and the mission is to provide more people with opportunities to invest in fine arts easily. According to them, artwork made by some of the world's most significant artists tend to appreciate at the highest rate, but very few people can access them due to the price point, which is very high. Masterworks aim to make it possible for anyone to invest in this asset class by offering the opportunity to enter at an affordable price point. Masterworks do not display art, at least as yet, and that's probably one limitation. It's not hanging on the wall. Other people cannot enjoy it, which is very different from what Particle is trying to do. So cultural value is not there yet. So it's not for enjoyment. It's some kind of aesthetic utility, or maybe for educational purposes. At the moment, this type of art is from Masterworks, is for investment purposes only. According to Masterworks, art as an asset class is not a GameStop or an NFT. At the end of the day, the returns on fine art are pretty predictable, and investing in one of these paintings, if you do that, you'll earn something like 10 times your money probably, but you probably won't do that or earn 10 times your money, which is possible in the crypto space, but you probably are not going to lose 90% of your money. And one of the rules of investments, according to Warren Buffett, number one is don't ever lose money. And as such, Masterworks isn't a platform backing up-and-coming painters. They're not focusing on emerging artists. They're focusing wholly interested in artists with a proven market around the value of their work, typically in the millions. They really believe that the investable segment of the market are paintings that are worth $1 million or more, generally speaking. And that's what they mean by investable. So Masterworks, what they do, they buy and store a number of paintings by famed contemporary artists like Andy Warhol and Jean-Michel Basquiat, Kusama, and selling shares in qualified public offerings that are registered with the SEC. And this allows investors to trade those shares on the secondary market once an offering closes. Shareholders get paid out when Masterworks eventually sells their paintings. Now let's have a look at what is fractional NFT and how does it work. So you can, so far we've spoken only about what is physical art, how that physical art can be fractionalized, but NFTs themselves can be fractionalized as well. So let's have a look at how that works. It opens up NFT ownership to small and mid-tier investors, and instead of just being accessible to people with very fat accounts, or whales as we call them in the crypto space. A fractional NFT is simply a whole NFT that has been divided into small fractions, allowing different numbers of people to claim ownership of a piece of the same NFT. The NFT is fractionalized using a smart contract that generates a set number of tokens which are linked to the indivisible original. And these fractional tokens give each holder a percentage of ownership of an NFT, and it can be traded and exchanged on secondary markets. At its core, an NFT is just a token that uses, in most cases, not all, but in many cases, it uses Ethereum's ERC-721 standard. The smart contract will split the ERC-721 token into multiple fractions in the form of ERC-20 tokens based on the instructions provided by the NFT owner. The owner will typically outline the number of ERC tokens that will be created, their price, the metadata, and some other properties. Each fraction, or an ERC-20 token, represents partial ownership of the entire NFT. The fractions are set up for sale at a fixed price for a set period of time, or until maybe they're sold out. NFTs and fractionalized NFTs aren't just limited to the Ethereum blockchain. There are other blockchains that do that, like Polygon and Solana and Unique Network. They all support smart contracts and can facilitate the creation and transfer of NFTs because of their really fast transactions and low fees. Interestingly enough, this fractionalization process can be reversed, and fractionalized NFTs can be transformed back into a whole NFT. The smart contract that fractionalized these NFTs in the first place will typically have a buyout option that will allow NFT investors to purchase all of the fractions and unlock the entire unique NFT. So it's to reverse this process is also possible. Now let's have a look at what are the benefits of NFTs and fractionalizing, generally speaking. There are at least three major ones, and then there are some secondary ones. One is democratization. So fractionalizing an expensive NFT or piece of art will lower ownership costs and make it more accessible to a broad range of investors. It's also about price discovery, because fractionalized NFTs can provide price discovery mechanism that determine how much a particular NFT is worth. Because the fractionalization and tokens that created as a result of that are sold on the open market, the prices can help to provide a reasonable valuation of a tokenized asset's price. A third major benefit is more liquidity, because the most defining feature of NFTs is that they are one of a kind. They are unique assets, unique tokens, and they can't be replicated or divided. And this uniqueness limits access to NFTs, especially valuable ones, and only a few very wealthy investors can really buy them. The fractionalized NFTs address this lack of liquidity, because the ERC20 tokens can easily be traded in secondary markets. Instead of waiting for months and weeks, and not even maybe even years, for one NFT to sell, investors may be more willing to buy fractions of this NFT ownership, and in this way they can address market illiquidity. But there are other benefits as well. Some tokens provide governance rights depending on the NFT and the platform where the fractional NFT was purchased. The holder may gain some local governance rights on that platform. And the example were 10,000 CryptoPunks. There are only 10,000 of them in existence, 10,000 NFTs. And due to their expensive price tags, they have relatively few sales. So the secondary market is not very well developed. And at the beginning, they were probably struggling to sell that as well. But in April 2021, last year, what they decided to do is to come up with a collection of 50 CryptoPunks, and they fractionalized that in 250 million tokens, each representative of part of this collection. These fractionalized NFTs, which they called UPunk tokens, had a collective market capitalization of just about $13 million in February 2020. That's just a couple of months ago. Holders have the option to bid on any of the CryptoPunk in the collection. And if 50% of these 250 million vote to unlock the collection, then each of the NFTs will be awarded to the highest bidder. Also, some of the platforms allow staking. Some projects like that support staking, enable holders to earn a passive income in addition to voting rights. For example, Mutant Cats, it's a collection of 9,999 NFTs, avatars, which are similar to the ape avatars by the Bored Ape Yacht Club, except that the mutant cat avatars feature colorful mutated cartoon cats. So that's just an example of a collection that supports staking. The project has fractional shares. They're called Fish. each representing fractional ownership of the NFT, and each mutant cat, NFT holder, can stake them to earn certain number of fishes per day. They also gain exclusive access to the mutant DAO, decentralized autonomous organization, access to their community, and also the voting rights that go with the DAO's assets. Now, let's very briefly look at what returns can you expect from an art investment and NFT investment. Even with traditional art, it's challenging to guess what will be valuable in the future. Should you buy what's popular? Should you try to find the next big thing? Maybe an emerging artist, an emerging collection? Investing in art can be highly speculative. Traditional estimates say that returns on investment in art may be overstated. There was a study, a very comprehensive Stanford study back in 2013, which was called "Does It Pay to Invest in Art?" And they said that many paintings that have higher price appreciation are more likely to trade. And this strongly biases estimation of returns. And they eventually found that a more realistic estimate of the returns from art investing is something like 6.5%. So it's not huge. It's not bad, but not huge. The tokenized art market has been around for such a short time that we really don't know what the investment returns are going to be like. There's not enough data about performance. One may expect to run somewhere between these 6.5 returns on traditional art investments and all over the map returns of crypto tokens, that meaning that you could lose everything, but also you can make a fortune. We just don't know at this point in time. With a normal NFT, if you look at what gives value to an NFT, there are different components of that. It may be utility, ownership history, it may be future value, liquidity premium, and fundamentals are not that different from those prized work of art in the real world and the physical assets as well. With fractionalized NFTs, however, the picture is slightly different. They actually alter all these fundamental components of value. Ownership history all of a sudden is now divided among a very wide range of participants. The resulting utility from the fractionalized tokens varies a lot. Liquidity is now higher. Instead of just one asset, there are many little bits and pieces of these assets, and the future value will change according to all the other features. An example of that may be the iconic Doge meme NFT that's related to the cryptocurrency Dogecoin that sold for $4 million in June 2021, and it's now speculated that it's worth $220 million, and that's only because they split them into 17 billion pieces. Yes, 17 billion. And the buyer collective known as Pleaser DAO fractionalized the NFTs 17 billion times, and allowing anyone, people on a very modest budget, to own a piece of this collection for just a few pennies. Because we're talking about investments, well, what are the risks? Every investment is coming with its risk. If you're already a crypto enthusiast, you might think that tokenization of art and the fractionalization of art, it's really a cool thing, but there are risks. Financial advisors don't typically recommend art or other alternative investments, such as private equity, fine wine, or even Bitcoin for the average investor. But investors who have a higher tolerance for risk may want to consider adding tokenized art and fractionalized art as an alternative investment to a very well diversified portfolio of theirs. Like all digital tokens and cryptocurrencies, art tokens are vulnerable to loss, theft, and hacking. You must understand how to very securely store these assets to avoid any disappointments and losing your investments. So buying and selling tokens also come with its own set of income tax liabilities and challenges, and investors should be very well aware of the tax implications before buying and selling tokens. So you clearly need to understand how the tax component, income component works. And the last point that I want to make is about the legal frameworks. For now, most fractionalized securities are operating under what the SEC Commissioner Gary Gensler has called the Wild West. It's an unregulated environment where, for now at least, anything goes, and where buyers with the funding and access can put their money in everything from digital whiskey funds, yes, those do exist, to fan coins, for example. From a legal perspective, selling digital shares of artworks amounts to trading securities defined as investment instruments of debt or equity that can be actively traded for profit. Therefore, similar to a public company issuing shares, service providers and platforms for fractional artwork ownership need to be accredited to do so. So please check if whoever you're buying it from is accredited to properly accredited. When companies break up an asset and allow investors to buy and sell pieces of it, they run the risk of that thing being a security. And that's especially true for small players who may not have all the savvy, the market savvy, the tech savvy, the bunch of lawyers and business advisors to avoid clashing with the SEC. Gary Gensler, again from the SEC, he said that the SEC has plans to regulate cryptocurrencies and NFTs, and any decision on those could be seen as applicable to all fractional assets. So we need to really follow the space, particularly if you are residing in the US. Fractional NFTs raise a lot of red flags and can be viewed by regulators in the same way as unauthorized ICOs in initial coin offerings that we saw in 2017, 2018. And it's not clear as yet whether our regulators are prepared to play ball when it comes to NFTs and fractionalized art. Fractional NFTs are more likely to be considered securities. And if projects like Masterworks advertise their fractionalized art as investable, that's clearly sending a signal to the regulators that that is a security. And here are some of my parting thoughts, final thoughts. Fractionalized art and collectibles is an important trend. Whether you're talking about physical art or digital art, I think it's here to stay, and it's probably a very, not just a significant thread, but it's on the trend, but it's also a positive trend. Fine art, fractionalization in particular, probably is here to stay. Fractionalization, in my view, allows democratization of art ownership. You can now own an iconic piece of art without having a fat bank account. This type of investment is uncorrelated with the stock market and can offer decent returns, not spectacular returns, but more or less good returns. There are, however, risks that you as investors need to be aware of. It's loss, theft, and hacking. And if you're buying art for investment purposes, most likely it will be considered a security with all the income tax implications that follow. So please check what you're buying, what you're selling. Be very careful if you're aiming for a long-term investment and creating wealth with the help of art and NFT assets. Well, that's it for today. Thank you very much for joining, and I will see you next Friday at 2 p.m. Dubai time. Now time for some jazz.